By the end of this video, you'll clearly understand the two dominant investing mindsets, growth and value, and more importantly, how they mirror the way we make decisions in business, careers, and life. You'll see why the smartest investors don't pick sides, but build balance. And you'll walk away with a practical way to think about risk, patience, and long-term success that you can apply immediately. Let's start with a simple truth. Every meaningful decision in your life sits on a spectrum. On one end, there's excitement, speed, and ambition. On the other, there's stability, discipline, and patience. Investing is no different. And that's exactly what growth stocks versus value stocks represent, not just financial strategies, but two philosophies of progress. As you're looking at the opening slide, notice the contrast already forming. Growth stocks versus value stocks. This isn't about which one is better. It's about understanding what each one rewards and what it punishes. Growth stocks are built on belief that the future will be bigger than the present. Value stocks are built on restraint to wait until the price makes sense. Every investor, entrepreneur, and builder leans toward one of these instincts, often without realizing it. Here's what we'll uncover now. Why these two styles exist, why both have worked historically, and why relying on only one can quietly sabotage long-term success. As the agenda comes into view, keep this in mind. This video isn't about memorizing definitions. It's about learning how to think, because once you understand the thinking, the tactics become obvious. Now, shifting focus to the big picture. Every investor faces a recurring dilemma. Do you chase what could be, or do you buy what already is? Growth stocks promise acceleration. Value stocks promise resilience. One feeds ambition, the other feeds survival. And here's the key insight that ties everything together. The market doesn't reward excitement alone, and it doesn't reward caution alone. It rewards balance over time. That's why the smartest portfolios don't guess. They balance. And that brings us directly into growth stocks. Slide 4 explores growth stocks at their core. Growth stocks belong to companies expected to grow revenues and earnings faster than the overall market. These companies usually don't pay dividends. Instead, they reinvest everything back into expansion, innovation, and scale. Think about early Amazon, early Netflix, early Tesla. These weren't cheap companies by traditional metrics. Investors weren't buying today's profits. They were buying tomorrow's dominance. And that's the mindset behind growth investing. You're betting on what the company could be it already is. But here's the trade-off. When you pay for the future, expectations become fragile. Miss one earnings report, one slowdown, one shift in sentiment, and the stock can fall hard. Growth rewards patience, but it punishes impatience even more. Building on that idea, let's look at the psychology behind growth investing. Growth investing is about optimism, vision, belief in innovation. It's the same mindset entrepreneurs have when they start something new without guarantees, high potential upside, high emotional volatility. You see this clearly in founders who reinvest every dollar back into growth. No dividends, no comfort, just scale. And it works, sometimes spectacularly. But it also explains why growth investors must master emotional discipline, because when markets turn, growth stocks feel it first. This brings us to the counterbalance, value stocks. Shifting focus, notice how different the language becomes. Value stocks trade below what their fundamentals suggest they're worth. They're often boring, often ignored, sometimes misunderstood. These are established businesses with steady cash flow, tangible assets, and often dividends. Think Coca-Cola. Think consumer staples. Think insurance companies. These aren't exciting stories. They're reliable ones. Value investors aren't asking, how big could this get? They're asking, what am I getting for the price I'm paying? And that question changes everything. Here we move into the value investing mindset. Value investing emphasizes margin of safety, discipline, restraint. It's about buying solid businesses at reasonable prices and waiting. Waiting is the skill most people underestimate. Value investing doesn't require prediction. It requires patience. And that's why it often outperforms during uncertain or recovering economies. When optimism fades, value holds, but value has its own cost. During roaring bull markets, value stocks can feel painfully slow. You watch others multiply returns while you collect steady dividends. And that emotional pressure pushes many investors out at exactly the wrong time. Now let's compare risks and rewards directly. Growth stocks offer explosive upside, but that upside is tied to expectations. When expectations change, prices fall, sometimes violently. Corrections of 30, 40, even 50% aren't rare in growth heavy portfolios. Value stocks, on the other hand, offer stability, dividends, downside protection, but they carry opportunity cost. When markets surge, value can lag. Neither style is safe. They're safe in different environments, and that's the lesson most people miss. Next, we bring both styles together. The most resilient portfolios combine innovation with stability. Growth fuels upside, value anchors risk. This is true in investing, and it's true in life. Early in your career, you take more risks. You invest in growth, skills, ideas, opportunities. Later, you protect what you've built. You invest in value, systems, income, resilience. ETFs make this blending easy, but the real work is psychological. You have to accept that not every part of your portfolio will outperform at the same time. That acceptance is maturity. Now, shifting from insight to action. Actionable takeaway number 1, screen intentionally. Look for growth stocks with strong earnings momentum. Look for value stocks with strong balance sheets. Number 2, diversify across styles, not because it's boring, but because it reduces emotional decision making. Number 3, review annually, not daily. Long-term thinking requires distance. And now let's pause for reflection. As you look at the reflection slide, ask yourself this honestly. Do you lean toward excitement or stability in life? Your answer probably explains your investing behavior more than any spreadsheet. Some people can't tolerate slow progress. Others can't tolerate volatility. Neither is wrong. But unmanaged bias is expensive. Where do you need balance? Not extremes. This brings us to the conclusion. Growth stocks and value stocks aren't rivals. They're tools. One builds momentum, the other preserves it. Master both, and you invest with clarity instead of emotion. In the long run, as Benjamin Graham said, the market is a weighing machine. Fundamentals matter. Discipline matters. Time matters. You can start today. Review your portfolio. Identify where you're overexposed, too much excitement or too much caution. Adjust slowly. Think long term. If you found this video useful, subscribe, hit the thumbs up, and check the PDF in the description. It breaks these ideas into clear frameworks you can apply immediately. And remember, successful investing isn't about being right all the time. It's about staying in the game long enough for balance to work in your favor. Thanks for watching. Download the PDF, subscribe for more, and I'll see you in the next one.